Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And today, wow, do we have a treat. We're diving deep into Match Group's latest annual report, and let me tell you, it is packed with more drama than a dating show finale. Alright everyone, settle in because Match Group Incorporated has dropped their big annual report, and it is a doozy, Match Group, right? They are the folks behind Tinder, Hinge, and a whole bunch of other apps designed to help you find your next connection, or at least your next swipe. So how is the business of love connection and maybe avoiding awkward dates doing? Let's find out. First up, the big picture on revenue for the year ending the 31st of December 2025. Match Group brought in a cool $3.487 billion. That might sound like a lot, and it is, but it is only a tiny increase of about 0.2% compared to the previous year. Now, let's zoom in on their biggest star, Tinder. Tinder's direct revenue actually dipped by 4%, a drop of about $77.7 million. This dip was mostly because they had fewer paying users, even though they did manage to get a little more money from each user who did pay. But it is not all doom and gloom. Their app Hinge is booming. Hinge's direct revenue shot up by a massive 26%, that is over $140 million more than last year. This growth is coming from both the United States and their expansion into new markets in Europe, and even South America. Their user numbers went up by 18%, and they got more money from each of those new users, showing Hinge knows how to keep its users engaged and paying. Over in Match Group Asia, revenue slid by about 6%. They've been hit by some significant shifts, including shutting down certain live streaming services and the app Hakuna. Plus, a strong US dollar has made their international earnings look a little smaller when converted back. Looking at the user numbers, Tinder saw a 7% drop in paying users. That is a pretty significant chunk, and it is clear they are facing challenges keeping users engaged, especially younger ones. Hinge, on the other hand, grew its paying users by a strong 18%. This shows their focus strategy is paying off, attracting users looking for more serious connections. Even with fewer users, Tinder managed to get a bit more revenue from each of them, a 3% increase in revenue per Pascal year. This suggests they are successfully monetizing their existing user base, even if the overall user count is shrinking. Hinge saw an even bigger jump, with their revenue per Pascal year climbing 7%. This means Hinge isn't just growing its user base, but also increasing the value it gets from each user. Now, let's talk about profitability. Adjusted EBITDA, which is a key measure of the company's operating performance, actually saw a small decrease of 1% overall, going from about $1.25 billion in 2024 to $1.236 billion in 2025. Tinder's adjusted EBITDA dropped by 7%. This is driven by that revenue decline and some increased costs. Despite efforts to save money, Hinge continues to impress here too, with its adjusted EBITDA soaring by 36%. This strong growth in profitability mirrors its revenue surge, proving Hinge is not just attracting users but also making them valuable. MG Asia showed a 9% increase in adjusted EBITDA, which is good news, but it is coming off a rough previous year where they faced significant impairments. The cost of revenue actually went down by 4%. This is partly because they shut down some live streaming services and the Hakuna app, which reduced their operating expenses. Marketing costs stayed pretty much the same, which is interesting. Given Tinder's struggles, you might expect them to spend more to attract users, but it looks like they are keeping a tight rein on advertising spend for now. Now, this is a big one. General and administrative expenses jumped up by 11%. A huge reason for this increase is a $60.5 million legal settlement for Tinder and another $14 million settlement with the FTC related to certain apps. Plus, they had higher severance costs due to workforce reductions. So, while they are trying to cut costs in some areas, legal battles and restructuring are hitting them hard. Product development costs increased slightly, mainly due to more spending on software and stock-based compensation for their tech teams. This is not surprising as they are investing in new technologies like AI. Depreciation decreased by a significant 23%. This is mostly because older software assets at Tinder have reached the end of their useful life and are no longer depreciated. Impairment and amortization of intangibles also dropped by a hefty 48%. This is good news because it means they are not writing off as many investments in intangible assets as they did in the previous year when they had to account for shutdowns like their live streaming services and the Hakuna app. Let's look at the bottom line. Net income attributable to shareholders actually increased by 11%, reaching over $613 million. This is a positive sign even with some revenue challenges. This improvement seems to be driven by managing expenses better in certain areas and lower interest expenses after paying off their term loan. On the balance sheet, their cash position looks strong. They have over $1 billion in cash and cash equivalents, up from about $970 million at the end of the previous year. This gives them plenty of flexibility. Their total long-term debt is around $3.5 billion. They did take on new debt by issuing 6.125% senior notes in August 2025, but they also paid off their term loan, so their overall debt level is managed. Looking at cash flow, they generated over $1.08 billion from operations. This is a solid increase from the previous year, showing the core business is generating healthy cash. And for shareholders, something new and exciting this year: dividends. Starting in January 2025, they paid a quarterly dividend totaling over $186 million for the year. This is a significant shift, showing a commitment to returning value to shareholders. They have also been actively buying back their own stock, repurchasing over 7.2 million shares in the last quarter of 2025 for about $32.94 per S-share on average. This shows confidence in their stock value. Now, behind all these numbers are some critical accounting policies. The company has to make estimates for things like goodwill and intangible assets, which are really important for acquisitions. They regularly check if these assets are worth what they say they are on the books. For instance, they did take a hit of nearly $29 million in impairments for intangible assets related to shutting down live streaming services and the Hakuna app. Their income tax rate for 2025 was 18%. This is lower than the statutory rate, partly because of new tax laws like the One Big Beautiful Bill Act that provide tax benefits. Now let's talk about risks. Match Group is facing a lot. They are in a super competitive market where people can easily switch between dating apps. They are heavily reliant on app stores like Apple and Google, who can change their rules and fees anytime, which caused problems for their Azar app. Plus, they just had Azar removed from the Apple App Store in February 2026, which is a major blow. This could mean writing off significant intangible assets and goodwill associated with that brand. They're also worried about inappropriate actions by their users like scams or fraud, which can harm their brand reputation. They are investing in things like FaceCheck to verify users, but it is a constant battle. They are also navigating the challenges of using artificial intelligence, or AI. While they are using it to improve their services, they know it comes with risks around data privacy, potential biases, and even cybersecurity threats. And finally, let's wrap up with my take: Match Group is in a tough spot. Tinder, their flagship product, is seeing declines, and they are undertaking a major strategic shift to improve user outcomes, especially for women, which they admit could hurt revenue in the short term. Hinge is the shining star, showing impressive growth in users and profits. They are also heavily focused on cost cutting through restructuring, but ongoing legal settlements are a significant drain. Their cash flow is strong, and they are returning capital to shareholders through dividends and buybacks, which is positive. However, the removal of Azar from the Apple App Store is a serious concern and could lead to asset write-downs. The company's direction seems to be a balancing act between innovating with AI and managing declining user bases in key segments, while also dealing with aggressive expansion in others. They are clearly trying to reinvent themselves through a portfolio strategy and a focus on user trust and safety, but the path forward is not without significant hurdles. Alright? That is our deep dive into Match Group's financial report. What do you think about their strategy and these numbers? Are you swiping right on their future or looking for a different connection? Let me know your thoughts in the comments below. If you found this breakdown valuable, hit that like button and subscribe for more corporate deep dives. And hey, join our Discord community for even more discussions and insights, link in the description. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.